It's time for a 360 round. We're taking a look at the jobs picture. We've gotten in the job openings, the JOLTS report today, and it really just shows that openings are coming down. In fact, we saw the job openings fall close to four-year lows. It's lower than last month. And, you know, you look back, right now it's 7.6 million. And it was a record 12.2 million in 2022. What do we need to know? Noah Yosif's with us, Chief Economist, Head of Research, American Staffing Association, and Jordan Shapiro, Senior Managing Director, Head of Financial Services at BlackRock Group. Thank you both for being with us. So, Jordan, I'll start with you. Some of your thoughts.
I think it's important to understand what information we're actually receiving from the JOLTS report. And while the headlines usually cover the total number of job openings and increase or decrease thereof, the information contained within this report that's most relevant to me are the number of quits, which represents the number of people that move jobs during the time period, as well as the number of layoffs that are reported in this piece of economic data. If you look at those two pieces of information, those have been relatively steady over the last couple of months, a little over 3 million movers in December 2024 alone. When you see those numbers steady, that to me represents a relative equilibrium in the employment market. And I also think that a number of 7.6 million jobs opening also supports a very strong U.S. labor market. So when we have a fair number of people moving jobs but being rehired, a decreasing number of layoffs occurring, and still a relatively high number of job openings, 7.6 million jobs is a lot of jobs. That represents a fair percentage of the total U.S. labor market. I think what we gained from December is a continuation of the healthy labor market that we've enjoyed in a post-COVID recovery.
Yeah, and the quit rate, 2%, is pretty much unchanged at the 2% rate. Jordan, some of your thoughts? I'm sorry, Noah, some of your thoughts?
Yeah, absolutely, Nicole. So these numbers tell me that the relief that the labor market received from the Fed's series of interest rate cuts last year was in fact temporary. As we saw last week with the employment cost index, compensation costs paid by employers to their employees is still much too high. And quite similarly, with the hawkish pivot that the Federal Reserve seemed to take last week with respect to keeping interest rates at a relatively high level, there really isn't much surprise to me that we're seeing fewer amounts of job openings as well as hires to boot, because employers are simply waiting for additional confirmation of lower compensation costs before they decide to increase headcount.
You know, it's worrisome when I see unemployment now. People collecting unemployment benefits has risen to the highest level since 2018. You know, if you take out the pandemic years, and that's what this article says. I just don't love to see that it takes folks longer to find a job. So while we say that the job scenario is looking good, why are they taking longer to find a job, and why are so many people on unemployment, Jordan?
I think the length of time unemployed is going to continue to grow as we transition to more of a knowledge economy. When you have higher skilled, more specified workers, those workers are going to be attractive to a narrower segment of the employment market in general. So when we move from hourly wages towards salary wage and more knowledge workers, those workers are going to have, at times, more challenges when they're looking for a new job. The unemployment numbers aren't particularly changed month over month. And while certain people are claiming more unemployment, we also see seasonal matters that are affecting that. But when we have an unemployment rate of essentially 4, I do believe that that's a point of theoretical saturation in the employment market. And while not everyone has the ability to work in the sector that they desire, nearly all Americans who are capable of working will be able to find a job in this economy should they want it. It means that we need to keep training our workers on more technical skills. We need to keep pushing STEM and education, because that's what's going to continue to carry this labor market forward with strength. It's not going to be hourly and lower paid workers. It's going to be the knowledge economy that's going to keep this labor market strong, as it has been, again, in the recovery.
Right. And Noah, when I think about Friday, we're looking at the estimates for 154,000 non-farm payrolls. The Fed is watching too. Some of your thoughts on what we could see on Friday, because you're also having immigration, less immigration, you have deportation. There's different stuff that's all happening. Your thoughts about what we could anticipate for Friday's jobs report.
Yeah, absolutely, Nicole. So, quite broadly, the labor market is being governed by two key trends. The first is how much employers are paying in terms of compensation, and the second is how confident employees are in terms of being able to go back out onto the labor market and find a new job. As Jordan mentioned, the labor market is fairly healthy. We do have a low unemployment rate. However, the labor market is not growing. And so, therefore, while we may see an increase in non-farm payrolls, they're probably going to be concentrated within the very same sectors that have been carrying the labor market for much of the latter half of last year. Furthermore, this year we can definitely expect to see an increase in economic policy related shocks to the overall health of the labor market, as you mentioned, immigration as well as tariffs. Those are going to primarily affect labor market momentum in terms of the costs that employers face in terms of bringing on more headcount, as well as employees' confidence in finding a new role.
All right, I have to jump in here. Noah, Yosif, and Jordan Shapiro, thank you both so much for being with us. Appreciate it.